Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about the global economy. If you've been following the channel, you'll know that during the second half of 2022, it was expected that the global economy would go into some form of recession during 2023, partially as a result of Russia's invasion of Ukraine, which drove up commodity prices all around the world. And the increase in those commodity prices drove up inflation, which meant that we had increasing interest rates in a lot of economies. And it was expected that the increase in those interest rates would have a detrimental impact on a lot of economies. And as the global economy is interconnected, it was expected that we would see some form of recession. However, over the course of the last few months, the impact of the increase in interest rates hasn't been as bad as expected, and it looked like the global economy was going to avoid a recession. However, over the course of the last few weeks, we've started to see signs coming out of China that the recovery is not as strong as expected, and there are now major question marks as to what's going to happen in the Chinese economy, which is the second largest economy in the world. And the initial data for May has now been released for China, which shows that industrial activity is now falling faster than expected. And alongside that data, we've also got negative data coming out of Japan, which is the third largest economy in the world, Germany, which is the fourth largest, and South Korea, which is an important supplier of technology products. So in today's episode, we'll have a look at exactly what's happening in China. We'll talk about the problems in Japan, Germany and South Korea. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in the global economy over the course of the next 3 to 6 months. Now, we talk a lot about the global economy on the channel, and the global economy is basically just an amalgamation of all of the individual economies around the world. And this graphic, produced by Visual Capitalist, gives you a really good representation of the importance of all of those individual economies. And as you can see, the United States is the largest single economy in the world, producing GDP of over $25 trillion, which represents around 24% of the total global GDP of around $104 trillion. The second largest economy, with just under $20 trillion, which represents around 19% of the global GDP, is China. Third on the list, with just under $5 trillion of GDP, or around 5%, is Japan. Germany is currently the fourth largest economy in the world, representing around 4% of global GDP. Number 5 and 6 are the UK and India, which both hold a share of around 3.5%, although India is growing at a much faster rate than the UK and is now likely to be the official 5th largest country in the world. France is the 7th largest economy in the world. Canada comes in at number 8. Italy at number 9, and at the time when these figures were put together, the joint 10th largest economies in the world were South Korea, Russia and Brazil, who each represented around 1.75% of total GDP. And the reason that I wanted to share this graphic with you was really to just show how disproportionate the global GDP is. The United States and China combined represent 43% of global GDP. If you then add Japan, that takes you to around 50%. And then if you add all of the countries we just run through, which represent the top 10, that represents more than 2/3 of global GDP. So what happens in all of those individual countries has a really big influence on what happens in the global economy. Because if you follow the channel, you'll know that I've said it a million times before, the whole world is interconnected. So if an individual economy is doing particularly well, that will have a positive impact on the rest of the world. If it starts to suffer and go into decline, it will have a negative impact. And obviously, the bigger the economy, the bigger the impact. And in today's video, we're going to look at negative data that's coming out from China, the second largest economy, Japan, the third largest economy, Germany, the fourth largest economy, and South Korea, which is the 10th largest economy. If you've been following the channel, you'll know that I recently posted a video looking at all of the data that was coming out for April. However, we're now starting to see some of the data being released for May. And that information shows that China's factory activity shrank faster than expected. This chart shows the movement in the Manufacturing Purchasing Managers Index over the last 12 months. This index is seen as a really important indicator which shows what's happening in the economy and what's likely to happen over the coming months. The index itself is put together using information provided from surveys undertaken by purchasing managers. So these are the guys who are working in factories, who are ordering in all of the raw materials to make sure that they've got sufficient stock to keep all of their manufacturing flowing. The scale on the right hand side of this chart runs from 48 at the bottom to 52 at the top. and the key measure in this index is 50. If the Purchasing Managers Index is above 50, that means that the company is growing and expanding. If the result is below 50, it means it's contracting. And what this chart shows is that in every month between August 2022 and January 2023, the PMI index was below 50, so that indicated that Chinese manufacturing was contracting. However, in February it shot up above 51.5, which at that time indicated strong growth, and there was a lot of positivity that China was bouncing back, all of the COVID restrictions had been released, and everybody had a very positive outlook for the rest of the year. However, that position turned out to be very short-lived. In March we saw the index at 50, which means that there was neither contraction nor growth. However, in April it actually fell to 49.5 against market expectations of 50.3, so this was a surprise to the markets. And the figures that have now been released for May show that it's fallen further to 48.8, which is lower than the market expectation of 49.4 and is now the lowest position that this index has been for the last 5 months. This chart plots the Purchasing Managers Index over the last 18 months for both the manufacturing sector, which is shown by the red line, and the non-manufacturing sector shown by the blue line. And if we look at the manufacturing sector first, you can see that during 2022, the index was at or below the critical 50 mark, which means that the industry was really struggling to deliver any positive outlook in terms of growth. And this was really linked to the zero tolerance policy that was still being implemented in China with regards to COVID-19. So China was still locking down tens of millions of people on a regular basis, and that was having a direct negative impact on manufacturing. However, those restrictions were finally moved at the end of 2022, and as a result of that, we saw the PMI index cross over the 50-point level, and in February 2023, the outlook was very positive for China. However, as you can see from the graph, that positivity has been very short-lived, and it will be very interesting to see over the course of the next few months if we see a continuation of the downward trend in terms of the PMI index, or if China can manage to turn things around and bring it back above the 50 level. And if we now have a look at what's happened in the non-manufacturing sector, you can see that it's followed a similar trend. However, the levels have actually been much more pronounced. So in the first half of 2022, we saw a major fall in the non-manufacturing PMI to around 42. We then saw the index bounce back to a level of around 55 in the middle of 22. However, by the end of the year, it was back down around 42. At the start of 2023, we've seen the index bouncing back again to a level of around 57. However, over the last couple of months, we've seen that coming back down, and it's now sitting at around 54.5. So both of these indexes are following a similar trend, and the concerns right now is that they're on a downward trajectory. This chart shows the percentage year-on-year movement in China's imports over the last 18 months. For the majority of 2022, the level of imports remained flat. However, at the end of 2022, we started to see a reduction, and that reduction actually hit 20% in January 2023. Now, there was a bounce back in February to a slight positive result. However, that trend has subsequently been reversed, and in April 2023, we saw a reduction of 7.9% year on year. And the reason that this is concerning is that China imports a lot of raw materials, which it then uses in its manufacturing process to produce finished goods, which are then exported all around the world. So when China is seeing a year-on-year drop in its level of imports, that means that it's got less raw materials, therefore it will be producing less, and that tells us that over the course of the next 3 to 6 months, it's likely that we'll see a drop in China's output levels, and therefore the economy will be slowing down, they'll be producing less GDP, and that will have an impact on the global economy. This chart shows the year-on-year percentage movement in inflation in China over the last 18 months. And we've got two different indices shown here. The red line shows the CPI, which is the Consumer Price Index. So that's basically prices that are paid in stores and online by consumers, so you and I. And the blue line shows the Purchasers Price Index, which is also referred to as factory gate prices. So this is the price of finished goods that are leaving factories in China. So as you can see from the red line, China has not been suffering from the high levels of inflation that have been seen all around the world over the course of the last 18 months. At the start of 2022, inflation was running at less than 2%. There was some growth during the first half of 2022. However, by the end of the year, inflation was back down to around 2%. And in 2023, those inflation levels have been falling, and the current annual rate of inflation is now at 0.1%. So basically, there has been no movement in prices over the course of the last 12 months in China. And And if we now look at what's been happening to factory gate prices, at the start of 2022, factory gate prices were increasing by around 10% year on year. However, during the course of that year, there was a huge reduction in that rate. And by the end of 2022, factory gate prices were actually falling year on year. They dropped into negative territory. And that trend has continued throughout 2023. And currently, the annual rate of inflation for factory gate prices is a fall of 3.6%. Now, for anybody that's watching this who's had to live with high levels of inflation over the course of the last 18 months, you may be thinking that this represents good news because if prices are coming down, then that means that you're going to have more money in your pocket. But when factory gate prices are falling, it's bad news for industry because over the course of the last 18 months, we have seen global costs rising. The price of oil and gas and food and a whole host of other commodities rose dramatically during the first half of 2022, and those prices have remained relatively high when you compare them to where they've been sitting over the course of the last 5 years. So the problem that Chinese industry is now facing is that its costs are rising, but its factory gate prices are falling. So Chinese companies are currently selling their finished products for 3.6% less than they were this time last year. However, if you've had an increase in costs during that period, what that means is that you're having to absorb all of those cost increases yourself, and therefore you're making less profit. Japan is the third largest economy in the world, and the manufacturing industry represents a significant portion of its GDP. This chart shows the movement in manufacturing production over the course of the last 12 months, and you can see that in 9 of the last 12 months, the level of manufacturing has fallen. In April 2022, Japan experienced a fall of around 4.9%. However, over the course of the following 5 months, the trend started to improve, and by September 2022, manufacturing output increased by almost 9.5%, so it looked like Japan had turned the corner and managed to get itself back on track. However, unfortunately for Japan, over the course of the last 6 months, we've seen a reversal of that trend. Manufacturing output started to decline again, and in every one of the last 5 months, Japan has seen a year-on-year fall in their production levels. And the latest figures show that Japan's factory output unexpectedly fell in April, as production machinery orders slowed amid weakening global demand, casting doubts about Japan's economic recovery. Factory output fell 0.4% in April from the previous month on a seasonally adjusted basis, which was significantly lower than the market forecast of a 1.5% gain in the month. Output of semiconductor manufacturing equipment fell by 24.6%, while flat panel manufacturing equipment dropped 66.6%. The drop in domestic and overseas orders contributed to the decrease in chip-making equipment, whereas falling demand for smartphones and vehicle equipment affected flat panel making equipment. Based on the forecast index, production is likely to be significantly reduced in May, and with weak global demand for goods, production will likely remain weak for some time, said Kota Suzuki, economist at Daiwa Securities. This chart shows the movement in South Korean manufacturing production over the last 12 months. In the period between April and September 2022, South Korea did achieve positive growth in its manufacturing sector. However, over the course of the last 6 months, the manufacturing industry has gone into decline, falling on a year-on-year basis by 3.8% in November, 8% in December, 13% in January, and 8% in February and March. And the latest data shows that South Korea's factory production and retail sales fell in April, underscoring another tough quarter after the economy narrowly averted a recession in the first 3 months of the year. Factory output in April was down 8.9% from the same month a year earlier, compared with a decline of 7.6% in March and a year-on-year drop of 7.9% expected by economists. It was the biggest annual loss in 3 months. The all-industry output index, which includes the manufacturing as well as services sectors, fell 1.4% in April, marking the first monthly decline since November and the biggest drop in 14 months. On the consumption side, retail sales dropped 2.3% from a month earlier, after a 0.1% gain in the previous month, making the first monthly fall since January and the biggest in 5 months. Economist Heron Lin at Moody's Analytics said the latest data shows that producers are on a rollercoaster ride that will probably last for a few more months. A recovery in industrial production is contingent on a stronger export market, as easing inflation and the pause on monetary tightening will offer limited support to domestic demand. The German economy, which is the fourth largest in the world, has officially entered recession after household spending finally succumbed to the pressure of high inflation. Gross domestic product fell by 0.3% in the first quarter of 2023, which follows on from a decline of 0.5% in the fourth quarter of 2022. A recession is commonly defined as 2 successive quarters of contraction. Germany's finance minister, Christian Lindner, stated that German GDP showed surprisingly negative signals and added that comparing Germany with other highly developed economies, the economy was losing potential for growth. "I don't want Germany to play in a league in which we have to relegate ourselves to the last position," he said, referring to the forecasts of the International Monetary Fund, which predicted a recession in 2023 only in Germany and Britain among European countries. Robert Habeck, Germany's economy minister, went on to say that his nation's previous high dependency on Russia for energy supply led to the recession, but the growth forecasts were much bleaker. Under the weight of immense inflation, the German consumer has fallen to his knees, dragging the entire economy down with him, said Andreas Schürrle, an analyst at Bank. Household consumption was down 1.2% quarter on quarter, and government spending also decreased significantly by 4.9%. Commerzbank chief economist Jörg Kramer said the massive rise in energy prices took its toll in the winter half year. A recession could not be avoided, and the question is whether there will be any recovery in the second half of the year. Looking beyond the first quarter, the optimism at the start of the year seems to have given way to more of a sense of reality. A drop in purchasing power, thinned out industrial order books, aggressive monetary policy tightening, and the expected slowdown of the US economy all argue in favour of weak economic activity in the second half of 2023. So what's the summary and conclusion today? Well, as I said at the start of this video, during 2022, we were all expecting a recession to come in 2023. The knock-on impact of all of the increased prices for commodities that we saw as a result of Russia's invasion of Ukraine was starting to feed through. We had high levels of inflation, we had rising interest rates. That increases the cost of borrowing, puts pressure on companies and individuals that have debt. It causes a slowdown in the real estate market because it becomes more expensive to borrow money to move house. And so the knock-on impact of all of those factors was that we were expecting to see GDP starting to fall, certainly in at least 2 quarters, possibly even more. However, by the end of 2022, everybody became a lot more optimistic. Inflation had started to come down in most of the large economies, industry was bouncing back, and everybody had a much more positive outlook. But when you look at the data that we are now seeing coming out from China and Japan and Germany, which are the second, third and fourth largest economies in the world, the outlook isn't particularly positive. Now, I haven't mentioned the USA so far in this video, and the reason for that is that I don't have any latest data. But obviously the big news that's happening in the USA right now is that the country has hit its debt ceiling limit and needs that limit to be increased if it's going to be able to carry on spending at the same level that it wants to. Now, in all probability, a deal will probably be put together at the last minute to avoid a debt default, because the last thing that the global economy needs right now is the USA to go into default, because that will have a huge knock-on impact and will certainly put the global economy into recession. So whatever deal finally gets put to Congress really needs to be voted through if the USA wants to avoid shooting itself in the foot and causing the rest of the world major problems. So the positive news is that the USA is in charge of its own destiny. As long as it approves the increase in the limit, everything will be fine. But when you look at what's happening in China, Japan, Germany and South Korea, they aren't in control of their own destiny. Those economies are dependent on what's happening in the rest of the global economy. And as we're seeing, China is suffering from a slowdown in the global economy. It was expecting to be growing at a much faster rate now than it actually is. And whilst at the start of 2023, it looked like the economy was bouncing back, that bounce back now looks like a short-lived affair. And all of the data that we looked at today show that the trends are now moving in the wrong direction. And as China represents around 19% of global GDP, that's obviously a concern. But then when you add on top of that, Japan, which represents around 5%, Germany, which represents around 4%, and South Korea, which represents around 2%, we've got a significant chunk of the global economy that's underperforming right now, and that will have a direct knock-on impact to the rest of the world, because all of the countries that are selling products directly into China, Japan, Germany and South Korea will see a reduction in their orders, so therefore their sales will start to drop, and that means that their GDP will also start to fall. And so you've got that knock-on impact that starts to feed its way all around the world, because those countries will then order less from the people that they're buying from, and so it goes on. So as we discussed earlier in the video, Germany is now officially in recession. It's had 2 consecutive quarters of falling GDP. And that in itself is a major concern, because Germany is a big player in the global economy, but it's also the biggest economy in Europe. And when you've got the largest economy in a 27 nation bloc going into recession, that is going to feed through directly into those other 26 economies. So what we're looking at right now is contagion. A lot of other economies over the course of the next 3 to 6 months are going to start suffering from reductions in orders from Germany and China and Japan and South Korea and the UK and the USA and other countries around the world. So the main reason that I wanted to post this video is really to give you the heads up that we are not out of the woods yet. Everybody has been talking up 2023, saying that we're going to be fine. The recovery has now started. The global economy is in a healthy position and is likely to continue growing. However, the data that we've seen today does raise concerns about whether or not that growth will be sustained, whether or not China has actually turned the corner, or whether that was just a blip and it's now starting to see a major slowdown. And if that slowdown continues for the next 3 to 6 months, it will definitely drag down GDP for the global economy and put a lot more pressure on the rest of the world. So I'll keep you posted on any further news and developments as and when they happen. Hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.